Welcome to Westwood Capital LTV. I'm here with Darren Peacock today on Tuesday, the 1st of April 2025, as we launch our new product, our mid-term mortgage product. Darren, do you want to start us off with the product that's launching today, and we'll go in to talk about some of the benefits that it's got for some of our viewers?
Yeah, I think the product that we've launched today, I think it fits quite a niche in the market. We've been seeing quite a lot of our deals that we have supported, and then we've had to support with further extension and deed of variations of existing loans, which that's how we've come to this product being born, really.
Yeah.
We've seen clients who, for whatever reason, haven't quite hit the targets that they've hit from a refinance perspective, or they've found that the refinance with the more mainstream high street or mid-term mortgages have taken longer than expected. And then we've supported those clients with a further extension, which is good from our perspective, but from the client's perspective, obviously there's additional fees, extra legal fees, extension fees that come with that type of extension. So what we've created is a product that we can offer a 3-year or 5-year term.
Yep.
And that enables the client to have, where they feel that they're fitting in between, a bridge is too short, but actually they maybe will be able to hit that high street or prime refinance commercial
Absolutely.
mortgage product in 3 or 5 years' time. So it's a way of giving our new borrowers and existing borrowers the confidence and security that they've got that funding locked in without any additional revaluations or additional extra due diligence and no additional fees. So they've got a longer term to be able to then either grow the business to a sufficient level that they can find a refinance, or it may just be they want a fixed interest rate, interest only, don't want to make any capital repayments, and I want that for a longer period of time, but it also gives more flexibility than being fixed into a long-term product. So it fits that sweet spot for me where a bridge is just too short-term, but actually we don't know what the future holds, so we don't want to be looking into a 10-year term commercial mortgage.
Absolutely.
And it sits in the middle. So for me, it gives the confidence and security of a mortgage, but the flexibility of a bridge loan.
Absolutely. I think, a lot of our clients that have extended, some of them have extended because they haven't necessarily hit a refinance or a sale of a property if that's been an exit. But a lot of them actually have taken an extension for maybe 12 or 24 months purely and simply because it's been cheaper, because we've flipped maybe a retained product into a monthly serviced on another year's bridge, or they've asked if they can carry on servicing. So they've had another setup fee because we've had to give them an extension, or essentially it's a new product, a new loan, and they've serviced that. Which when some of our clients are getting a quotation from a longer term, traditional mortgage company, whether that be a bank, whether that be a high street independent, that it's caused they've looked at that monthly repayment and actually, wow, that's a lot more expensive than if we just carry on servicing a bridge, which will help cash flow for the next 12 months, etc. Maybe where there is where the clients don't have surety of where they're going just yet and would like to service. So I think that was one of the other reasons that this mid-term mortgage product came along, was purely and simply around that, and the opportunity for clients that if there is a 3 to 5 year product, actually they're looking to take an extended bridge, for want of a better word, because there might be an event in the future that they have planned to either sell that property or business, or a transaction in the future that they might be able to do that with. So I think that's another reason. And some of the other reasons we've seen some clients that inherently have great businesses, great properties, but maybe don't have great credit ratings.
Correct.
Whether that be business or personal. Mm-hmm. And when we look at some of those, that the businesses are making profit, the clients have got good personal income, great assets and liability statements, but we came across one client who sadly his credit rating was ruined for a £14 water bill, and just couldn't get a longer term mortgage until there was a time period put between the borrowing, really.
Yeah.
And that's what needed to be done. So we've had some clients to us who've had that and come for a 2-year borrowing to then maybe exit after that. But even a 2-year, 24-month product sometimes isn't quite long enough. So I think a 3 and a 5 year that we've introduced has, it's not a mortgage where we're taking companies that aren't making profit, that are struggling to afford it, but inherently there are specific reasons why they can't get that.
Yeah, exactly. And I think there's also the areas that can benefit from this type of product. We've seen quite a lot of our property developers in the holiday let sector. So they've developed properties into holiday lets, short-term lets, Airbnbs. And that's quite difficult to then term out onto a holiday let product without any of that trading history.
Yeah.
So we've seen quite a lot of clients and borrowers where they are actually generating significant income from that particular property, more than enough to prove affordability and serviceability of our loan. However, haven't done that over a say 12-month period to demonstrate that to a funder that will lock that out for 10 years. So we have the confidence in it's generating enough income now. We've seen that already, so we can offer you the 3 or the 5 year term. And then once you've got that track record and got a couple of years worth of accounting and trading of that particular asset as that holiday let, then they can step up there. Or alternatively, we have seen a few clients that are just quite happy. We're unique in the fact that we're 100% privately capital backed, so we're not affected by base rate. Now, base rate has stabled out a little bit now, and we're seeing a bit more stability. But as in Bank of England base rates were going up and then coming down a bit, and there's a little bit uncertainty in where the base rate fits. We're locking that out on a truly fixed product, so we're not affected by that. Nor will our borrowers be affected by that. So that gives them a bit of confidence as well, I think.
Absolutely. So hopefully this gives you guys watching a bit of an idea of where the product fits. It's not a traditional longer term mortgage. It is a short term, mid-term mortgage, which is locked out, serviced over a 3 or 5 year period. But Daz, I just wanted to go through the facility highlights really, which is a 2% setup fee and a 12% per annum fee. So then the biggest one that we're getting is we're still doing the same type of underwriting. It's still me and you, and we're still looking at a deal in the same way. And we can still give our client surety of speed, which in a mortgage market isn't there. So if a client's coming to us looking for speed on a transaction, looking to lock it out for 3 or 5 years on a buy-to-let, for instance, we can still provide that.
We can, yeah. Obviously, we'll still take the no search indemnity insurance in the legals. There are certain things that we're more than happy to put as a post-completion condition. So if the property is not quite there and it hasn't got its EPC, but we can see affordability and serviceability with that can come after completion. So you're right, we're taking, even though it's a mid-term product fixed and giving the client a lot more certainty on term and an extended term, we're still taking the same approach on due diligence and acting as if this is a very quick transaction and it needs to be done really quickly. So I think they're actually getting the best of both worlds in that scenario. So from the borrower's perspective, I think they'll see a difference, because if you set 2 people running on a full-on commercial mortgage and one of our mid-term mortgages, we would be completing way faster than anybody else, because of the underwriting we're used to, the way we push our legal through, and the way we work with our borrower solicitors to just get the transaction done for our clients. And then it gives them the certainty. And of course, just the 3 year, it comes with just a 1 year,
12-month minimum.
A 12-month minimum anyway. So for our brokers and borrowers alike, if they feel there's a chance they can get out around the 12-month period, they may as well take the certainty of the 3 year anyway, because they're not going to be penalised if they get out in month 13, 14,
Absolutely.
15, and so on. So because it's serviced and because there's no early repayment charges once they've hit the minimum interest period, they may as well take the certainty of the 3 year, and they're happy to get refinanced anytime after month 12.
I think that's absolutely key, is that the 3 year product comes with a 12-month minimum and the 5 year product comes with a 2 year minimum, but there is no ERC, so there is no early repayment charge with throughout that period. And once you've gone through that minimum period, you can either A, pay chunks off, or B, repay as in full with it after those minimum periods. And unlike some of our competitors that have a reducing early repayment charge, we don't. So I do think you're absolutely right. You have got the best of both worlds. That then flips on to we do a refurb, a bridging and refurb product as well. And if some of our clients are looking to buy a property, refurb it on drawdowns, which we've been doing now for a couple of years, that's to still have that option. But then they actually have the option at the end of that term to put it onto a longer term with us for a 3 or a 5 year, if that's what they wish to do.
Exactly. So you're right. We still got our core bridging clients that need a transaction now fast for assets that are not going to be spinning off any income on day one. But once they've refurbed that particular, I'm talking property here, once they've refurbed that particular property asset and got it to generate income, we can take it off that and we can effectively repay our bridging product with the commercial mortgage product.
Yeah.
To, again, just give the client certainty. And I think that's the key really. It's giving the clients the certainty of a longer term than a bridge, so a mid-term, but still with those only 12 months on the 3 year and 24 months on the 5 year, it gives them flexibility to refinance if they so wish.
Yeah.
And then we can, hopefully we've helped solve that mid-term product, and then they go on to a longer-term mortgage if they so wish, or hopefully they stay as a client and continue to service, and we'll support them. And also we have seen with a couple of our existing borrowers, they've stayed with us as opposed to moving on to a full high street term commercial mortgage, because there's no real interest or benefit for them and their business currently to be paying any capital off. So they'd rather stick on interest only, save that repayment element of what they would be paying off the capital to just improve their cash flow for a little bit. So where a business where cash is more important than reducing the equity in a property asset, I think that fits as well. So we can fix our interest rates, not exposed by any base rate changes. And again, it just gives them the security that it's just interest only, and then they can move on to a full repayment if they so wish in the future.
So when we're looking at the security stack, it's still very similar to our bridging product. However, on this one, we are looking for first charges only.
Correct.
And that can be for residential or commercial property. So it can be for businesses who are looking to buy their own property that they wish to reside in, so a business premises, or it can be for buy-to-let landlords who are looking to buy one or multiple buildings and utilise that first charge over that. So that element is there, and the rest of the security stack, still looking for a debenture on trading company. We're still looking for personal guarantees that back that.
Yeah, of course, and that's just standard. And as always, our personal guarantees are more of a commitment from the directors than to shore up financially. The asset will always be our primary source of security from a financial point of view. It's just them believing and standing behind their project for us. So yeah, I think it fits a gap in the market that we've seen, and really we've seen that from the experience within our existing loan book. And I think that's the key really. If this product would have been available from day one, we could have saved quite a lot of our borrowers some additional fees.
Yeah,
if they'd known it there. So it makes sense to offer it from day one. And if the clients choose to know that they're extremely confident they get out in a year, that's fine. But in my mind, why not take the comfort of a 3 year, and then
absolutely
you once you hit that year, you've got that freedom to move without any additional penalties.
You touched on an industry earlier, which is like holiday lets, Airbnbs, even the hotel sort of space, where clients need to demonstrate occupancy levels, they need to demonstrate profitability, they need to demonstrate running that business, or where maybe there's been a change of directorship. There are also a number of other industries that sort of covers as well, not just hospitality, but there are a number of other industries where you have to prove your business works before you can then go out and get it.
Of course.
Or you're buying a building which is predominantly your main trading asset. So I think that, you know, where these two products dovetail quite nicely is we've already seen we've got buy-to-let landlords going to an auction, need to make a purchase quickly, need to do some form of refurb, whether that's a light or a medium refurb, that we can then give them the drawdowns to complete that refurb. So it could be the fact that we're giving them, you know, 65, 70% on a refurb of the value of the property. We're also then giving them 100% of the refurb costs, and that takes, I don't know, up to 6 months. And then when we move on further from there, they've then got a trading asset that is, you know, a buy-to-let product, for instance, or a holiday let, which they're then able to let out over a term period, short term, you know, nights, weeks, whatever that might be. But actually then when we're coming out the other side of that, they've maybe only got 6 months trading. So, you know, whilst I appreciate there are some forecast-led mortgages out there, which again, they're not great rates. What this actually allows you to do is take that initial refurb bridge with us, put it on a mid-term mortgage, whether that's 3 or 5 years, get the trading that you need, the trading experience, the trading
Correct.
time, show that and have that written down so that when you're going for that 10 or 15 year, actually it might be slightly more expensive with us for a 1 or 2 year period after your bridge, which you'd always need because you need it to purchase it quickly and then refurb it. But actually then that catapults you further forward in that 2 year period to a better rate in that next 3 years, because you've actually go, right, well, I've got 2.5 years trading accounts, occupancy levels of this, we're making good quality profit, and away we go.
Correct. Yeah. So I see a decent gap in the market. I see how it can benefit so many different borrowers in so many different industries. We're excited to see it launched.
I think one of the things that we're not trying, worthwhile saying and helping, we're not trying to compete with the banks or the independent mortgage lenders out there. What we're actually trying to do is look after deals for a bit of a longer period, give a benefit to the customer, the borrower, which is of a little bit longer time in that mid-term rather than short-term, which we've been in for the last 2.5, nearly 3 years now, and give them that additional bit of support, which buys them time, which eventually puts them onto a better rate. Or if the more medium term is to get an asset functioning, put it on a longer term product, but actually within that period there might be ERCs because they're going to sell it, upgrade it, whatever that be. We offer something slightly different, where there isn't any product at the minute on that sort of mid-term price on a service basis, where they don't have to pay capital chunks.
Yeah.
Superb. Okay, well, if anybody's got any queries as of normal, please feel free to come through to us, and we'll try and help you accordingly. Thank you.
Fantastic.